All right, let's be real. It's 2 a.m. and you're not watching Netflix. You're deep in Zillow staring at houses you can't afford. Kitchens with real counter space, backyards big enough for a dog to exist, and every decent house under $500,000? Gone. Sold in 48 hours. Multiple offers. Waived inspections. It's like trying to get Taylor Swift tickets, except the prize is 30 years of debt. Meanwhile, the houses in your budget look cursed. Beige carpet that drains your soul, a kitchen stuck in the 90s, pink bathroom tile that should be illegal, and some minor issue the listing definitely didn't mention. So here's the real question keeping you up at night, and the one we're answering today. Can anyone actually afford a $500,000 home in America right now without turning their life into a financial nightmare? Because banks say you're approved. Agents say buy now or be priced out forever. TikTok finance bros say it's easy. But numbers don't lie. People do. I'm Jack, and today we're exposing the truth real estate agents won't tell you. Can you really afford a $500,000 house in 2026? Not just what the bank approves, but what you can actually handle without losing sleep over money. Before we break down the brutal, honest math, hit subscribe if you're tired of financial clickbait and fake advice. This channel is about real numbers and real life. Because yes, you can own a home without eating ramen for 30 years. Let's dig in. The reality check. Where most people actually are. Let's start with actual reality. Not Instagram reality. Not LinkedIn. Everything's amazing reality. Real life. According to the U.S. Census Bureau, the median U.S. household income in 2024 was about $83,730, and it barely moved from 2023. Translation: prices went up, wages didn't. And quick reality check on median. Half of American households make less than that. Half the country. So if you're making around $85,000 and still feel broke, you're not imagining it. You're doing better than most and it still feels tight, which tells you how broken this is. Now, most legit financial advice says housing should be about 28 to 30% of your gross income. And that's everything. Mortgage, taxes, insurance, repairs. Not just the payment. Why 30%? Because above that, saving, emergencies, and basic enjoyment of life start disappearing. Keep that number in mind, because a $500,000 house is about to blow right past it. What does a $500,000 house actually cost you? The real breakdown. The old rule is 20% down, which on a $500,000 house is $100,000. Meanwhile, the median American savings account is $8,000. Yeah, most first-time buyers scrape together 10%, meaning you're financing $450,000 and pretending you're not sweating. As of early 2026, the average 30-year fixed mortgage is about 6.1%, which makes your monthly principal and interest around $2,800. That's $1 million over 30 years for a $500,000 house. You're basically paying double just to live there and have walls. Put down less than 20% and say hello to PMI, the poverty tax for not being loaded, which costs $200 to $400 a month until you finally hit 20% equity. Add property taxes at about $500 a month, homeowners insurance around $200, and maintenance at $417, and suddenly your cute little dream house feels like a financial horror movie. And that's assuming nothing blows up. No roofs collapsing, no HVAC giving up in July, no mysterious smells that turn into $5,000 plumbing adventures. Some years are fine. Other years your wallet goes through emotional trauma therapy. Total real monthly cost. Brace yourself. All right, let's add it all up because this is where it gets really fun. On a $500,000 house with 10% down, the mortgage alone is about $2,800 a month. Add $300 for PMI, $500 for property taxes, $200 for homeowners insurance, and $417 for maintenance, and you're looking at roughly $4,217 every month. And that's assuming nothing goes catastrophically wrong. No new roof, no flooding, no HVAC dying in the middle of July at 105 degrees. This isn't affordable. This is a 30-year hostage situation where you wrote your own ransom note. So what income do you actually need? Remember that 30% rule? Let's do some reverse math. If your housing costs are $4,217 a month, that should be 30% of your gross income, which means you need to make about $14,000 a month, or $168,000 a year. Let that sink in. To comfortably afford a $500,000 house by traditional rules, you need roughly $170,000 a year. Banks are a bit more generous and might approve you with a higher debt-to-income ratio, but even then, you're looking at $120,000 to $140,000 just to get the thumbs up. Here's the kicker. Only about 25% of U.S. households make $150,000 or more. That means 3 out of 4 families can't really afford a $500,000 home without stress. Yes, the bank might approve you, but approval isn't the same as affordability. Approval means we think you can make the payments. Affordability means you can make the payments and still have a life. Big difference. Is affordability getting better? Spoiler, barely. So you might be thinking, okay, Jack, this is depressing, but isn't it getting better? I heard rates might come down. Yeah, kind of, but not really. According to Zillow's 2026 projections, mortgage payments as a share of median income are improving slightly. They're sitting at about 32.6% of median income right now, and they might fall below 30% in some markets by the end of the year. That sounds hopeful, right? Except here's the problem. The underlying fundamentals haven't dramatically changed. Rates have come down a little bit. Home prices have cooled off slightly in some markets, but are still sky high in others. And income growth is still barely keeping pace with inflation. So yeah, things are marginally less terrible than they were in 2023. Congratulations! Instead of completely impossible, we've upgraded to extremely difficult. And if you're trying to buy in major metros like San Francisco, New York, Seattle, or Los Angeles, forget about it. In those markets, affordability ratios are in the stratosphere. We're talking mortgage payments that are 50%, 60%, sometimes 70% of median income. It's genuinely insane. Real life. Example, let me paint a picture with a totally hypothetical, but painfully realistic family. They make a combined $160,000 a year, which is objectively good money. After taxes, they're taking home about $10,000 a month. They buy a $500,000 house, and their total monthly housing cost comes out to around $4,300. That leaves them with $5,700 for everything else, which sounds fine at first, until you look closer. Between 2 car payments, insurance, gas, health insurance, groceries, and basic utilities, they're spending about $3,000 a month just to function. Now add that to the housing cost, and they're at $7,300 out of $10,000. That leaves $2,700. And that's before retirement savings, an emergency fund, kids, medical bills, student loans, or doing literally anything enjoyable. No vacations, no eating out, no margin for error. Most months, they're basically living paycheck to paycheck. And this is a household making $160,000 a year, top 20% money in America. And they're still stretched thin. That's not bad budgeting. That's a broken system. The system isn't designed to protect you. Here's the part that really gets me fired up, and it's something real estate agents, mortgage brokers, and lenders really don't want to talk about. The system is not designed to make sure you can afford the house. It's designed to get you to buy the house. Think about the incentives. The bank makes money when you get a mortgage. The real estate agent gets a commission when you buy. The insurance company gets paid whether you thrive or struggle. The closing attorney gets paid. The appraiser gets paid. Literally everyone in the transaction gets paid when you sign on the dotted line. But nobody is making sure you can actually live a good life after the purchase. Nobody's checking to see if you'll be able to save for retirement, or handle an emergency, or I don't know. Enjoy your life occasionally. The system profits off of approval, not long-term financial health. That's why you'll get approved for loans that will absolutely crush you financially. Because it's not about you, it's about the transaction. So why are people still buying? Great question. If it's this bad, why are people still buying $500,000 houses? A few reasons. 1. Some people actually can afford it. If you're a household making $200,000 plus per year, you're fine. This video isn't for you. Go buy your house. Enjoy. 2. Family help. A lot of first-time home buyers get help from family for the down payment. If your parents can gift you $50,000, that changes the entire equation. But not everyone has that privilege. 3. People are stretching way beyond comfort. They're doing the math and thinking, okay, it'll be tight, but we'll make it work. And maybe they will. Or maybe one job loss, one medical emergency, one major repair completely ruins them. 4. FOMO and social pressure. Everyone around them is buying. Their friends are buying. Instagram is full of new home posts, so they feel like they have to buy or they'll be left behind forever. 5. They're betting on the future. They're thinking, I'll get a raise next year, maybe a bonus. Maybe we'll flip the house in 5 years and make money. Maybe or maybe not. And here's the thing the internet never talks about. Just because you can get approved for a mortgage doesn't mean you should take it. Renting versus buying. Let's kill some myths. I know what you've heard your whole life. Renting is throwing money away. And sure, that's what everyone says, but let's think critically. If renting lets you have lower monthly costs, stay flexible for your career, save for emergencies, invest in retirement, avoid a surprise $10,000 roof, and actually enjoy life, then maybe renting is the smarter move. There's no adulting achievement unlocked for being house poor. Homeownership is great when it makes financial sense and a disaster when it doesn't. And you know what's really throwing money away? Paying $300 a month in PMI, $3,000 in closing costs. Being so cash poor you can't invest for retirement and miss decades of compound growth. That's throwing money away. What you should actually do instead. All right, if you're seriously thinking about a $500,000 house, here's the real talk. First, run the actual numbers. Don't trust the bank's rosy calculator or the agent saying, you can totally afford this. Use a real mortgage calculator and include interest, PMI, taxes, insurance, and maintenance. Then ask yourself if you can pay that and still save for retirement, handle emergencies, and enjoy life. Second, know what afford really means. It's not about approval, it's about living a full life. Can you max your 401k, save 6 months of expenses, take a vacation, or handle a $5,000 emergency without panicking? If not, you can't afford it. Third, consider cheaper markets. A $350,000 house in a sane area beats a $500,000 house in a trendy city every time. Financial stability beats a fancy zip code. Finally, think long-term. Retirement, kids, medical emergencies. They don't pause because you bought a house. If a home keeps you from saving for life, it's a setup for stress and crisis down the road. Real wealth isn't borrowed, it's built. Let me leave you with this thought. Equity in a house isn't real wealth if you can't sleep at night. Real wealth is stability, having savings, investing for the future, the freedom to make choices, and actual peace of mind. It's not juggling overdue bills while your air conditioner dies in August and your HOA hits you with a surprise $2,000 special assessment. Homeownership can be amazing, but only when it's done right. If you're sitting there right now, finger hovering over the make an offer button, I want you to stop. Just pause. Run your numbers. Know your true monthly cost, and make this decision with logic, not emotion, not social pressure, not FOMO. Drop a comment below if you want me to break down affordability in your specific market. Just tell me your state or city and I'll try to respond with real data. And if you found this helpful, do me a favor. Like this video and subscribe. because we're going to keep making content like this. No BS, no hype. Just honest personal finance and housing reality. The bottom line. A $500,000 home is not automatically affordable just because a bank is willing to give you a loan. For most American households, and especially those earning below $140,000 to $150,000 per year, buying a $500,000 house in 2026 means stretching way past responsible financial limits. And this isn't about you not being good with money. This is about a housing market that is structurally disconnected from income reality. The math just doesn't math anymore. So make smart choices, protect your financial future, and don't let anyone shame you for being cautious. I'll see you in the next video.